Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I got a very special guest today, Chris Cullen, our returning champion from Brompton, Senior VP of the ETFs there. So today, how's it going, Chris? First of all, how are you, my friend?
Fantastic, Adrian. Thank you so much for having me back. I always enjoy having a little chat with you on your YouTube channel.
I do too, the audience does too, and today we're going to talk about two of my personal favorite ETFs at Brompton, SPLT and BMAX. So bear with me, Chris. I'm just going to share my screen 2 seconds in case some of my audience is not familiar, but I've spoken about these many, many times, so I'm sure they are. SPLT is the Brompton Split Core Preferred Share ETF. I talk about this ETF a lot when I talk about more stable, conservative ETFs, great for income investors, maybe to park cash or as a GIC alternative. In my opinion, this is my personal opinion, I think SPLT is a fantastic GIC alternative. So essentially this ETF is a collection or index-based collection of all the preferred shares of the split funds in Canada. Recently did a distribution increase. Can't wait to talk about this one and how great it's been performing, how stable it's been. And then of course you have BMAX, which is the higher yield one. This is one of the top all-in-one leveraged high yield funds, which also did a distribution increase. So we'll talk about BMAX as well, which is definitely a community favorite. People love how stable it is, a nice consistent stream of 9% plus yield. So we'll start with SPLT. I know you got a lot of stuff and graphs ready, so
You know, I'm
let's
a
just,
you know I'm a graph nerd, Adrian.
you're a
So
graph nerd. I love that. So am I. You always have nice graphs.
all right.
Um, so distribution increase, tell me a little bit about that. Tell me a little bit how SPLT has been performing, how happy you guys are with it, etc. The floor is yours.
Oh, that's great. Thank you so much for that lovely introduction, Adrian. I want to
Yeah.
just make it very clear, though, you do flatter SPLT by kind of comparing it to GICs and cash, that kind of thing. This is a good place to put cash, but I want to just remind everybody it's not a cash product. There is investment risk involved with any non-cash product. So this is, as you mentioned, an ETF that has split preferreds. It is a low risk rated ETF.
Yeah.
So this is, in the grand scheme of things, quite a good place to put your money if you're a conservative investor. It has very tax efficient dividends. As you mentioned, also there was a dividend increase. We just launched SPLT last June with a six and a or not six, yeah, 6.25% handle on the distribution. That's 62.5 cents per year, and we paid out regularly every month up until January. January is the time when we regularly review our distribution levels for all of our ETFs. And just due to rate increases for several of SPLT's holdings last year, as splits, as you know, Adrian, reset typically on a 5-year cycle. Some are closer to floating now, but there are various issues in the SPLT portfolio that reset to higher rates. The average increase for those resetting last year was an increase of about 1.8%. So quite significant. And it was for a material portion, not the entire portfolio, but a material portion of the portfolio. So it allowed us to increase the distribution rate. So we went from 6.25 of the initial $10 listing price to 6.6%. We increased to 66 cents per annum. Yeah, as I also mentioned, I'd like to nerd out with my graphs, so I'll put some of those up now too to talk about split and just give a quick update. So
Please do.
here's what we're looking at right now. This is the blue line that in front of you is the trading price since launch last June. So like day to day small fluctuations of a cent or two, a couple cents, but a general upward trend. That's what we like to see. The split prep market when we launched was trading at about a 95% of par level. So about a 5% discount to the redemption
5%.
value
Okay.
of par. That's evaporated. There's no discounts in the split pref market. It's trading right about par now. So that really drove the NAV increase from the launch date up by about 5%. So, I mean, is this the end for increases in the NAV? Nobody knows what the future holds, but I have been in this market for about 20 years now. And I've seen periods where split prefs have traded at 5 to 7% premium for an extended period of time. This is just due to investors looking for high yielding investments when there are few to be had, and they buy up those that offer it. So given the very attractive yield levels on split prefs right now, there is good potential for continued increase in the NAV for SPLT. The red line on this graph is simply the AUM growth. We started at zero last June, and we've grown the fund to about 150 million. So I think that's quite a tidy result, and we're quite pleased with the way that AUM growth has occurred in the last year or so. We're getting very good reception from investment advisors and from the public who we talk to SPLT about.
Excellent.
So the question about rates comes up, and split pref rates, and what's happening with resets and that sort of thing. And again, we don't have all the answers, but I'll tell you that last year we had 4 prefs in the SPLT portfolio, and they reset, as I mentioned, about 1.8% higher than their previous reset rate. There's 4 prefs this year that are coming up for reset. The first one that's scheduled is Brompton Lifeco split. So that's about a 2% weight in the portfolio. And we've announced an increase of 6.25 goes up to 7% of par. So there's a little bit of an increase there. And we will see 3 others that are more clustered in the 3rd and 4th quarter of the year. And so just given where bond rates are trading today, the interest rates on the Canada 5-year, which none of these split prefs are directly referenced to, but the yields on split prefs have something to do with the Government of Canada 5 rate, just given their term and given that that's a pretty common reference asset. And we're seeing Government of Canada 5-year rates trade about 1.5% to 2% higher in terms of their yield today than they were 5 years ago. So for 5-year resets that are happening in the split pref market, we could probably expect to see a good increase this year. So we'll keep monitoring that, and we will be reviewing again next January for income levels to be paid out by SPLT.
Very cool, very cool. I mean, the feedback I always get from people who in my community who hold this, they just love the stability. It's such a boring, nice 6% yield. It's just fantastic. It's been great lately. And just a quick question: when these reset, or we know that SPLT is an ETF that holds pretty much all or many preferred share split funds, and you've alluded many of them have reset recently. They're all resetting higher because the interest rate is going higher. Now that reset is valid for, correct me if I'm wrong here, typically for 5 years, right?
There's a number that reset every 5 years. Yeah, there's 4 that come up for reset every 5 years in the portfolio. They account for about a third of the portfolio, actually. So there's some major holdings that are resetting later in the year. Some of the split prefs have gone to more of a floating rate approach. BK is one. They have a formula that's kind of referenced to prime rate, and it's capped at 8% and a minimum 5 and something. So within a range, it floats. And then some have taken to confirming their distribution rate every year. A couple other Quadrivest products too. All of our products typically do a 5-year reset. The partner value split series does 7 years. They're outstanding for 7 years. So it varies, but 5 is a good rule of thumb. Middlefield and Strathbridge and those several others have 5-year resets as a pretty standard.
Yeah, that's what's cool about SPLT. You kind of have like all of them, all the providers. Not only does that give you some diversification of strategy and provider, but also a sector diversification, right? Because Middlefield, has the Enbridge one, the real estate one. Obviously, you guys, Quadrivest, a lot of financials one, but there's different ones, and then you have other ones as well. So really cool. So just to wrap up SPLT, unless you want to add anything more, I got 2 questions that I personally always get. So the first one is, why should an investor buy SPLT versus, say, a single split preferred share where they could get higher yield, right? They could get 7, even with the Brompton ones, you could buy some of them, I think LBS that reset at 7%. I think Quadrivest has FTN at 9%. So why should an investor choose SPLT versus a single split share preferred?
It's a great question. I mean, I hold a material amount of SPLT in my own personal portfolio, but I also do invest in single names myself. The difference really with SPLT has to do with diversification. There are 19 different split preferred holdings in SPLT. When you buy a single name split preferred, you're exposed to some degree to fund specific news flow, fund specific kind of changes in price, that kind of thing. You will see once in a while certain split corps get impacted by a sell-off compared to the rest of the market. By holding a diversified portfolio, you protect yourself from that.
Excellent. Makes sense.
A few other ideas that I want to just plant with you too is liquidity, especially for some of the smaller names that are out there. You can struggle to find liquidity if you're a material holder. Buying and selling can move the price by several cents. SPLT, what it offers is it offers the liquidity of all of the holdings, it wrapped in one neat package. So there's that as well. And there's also professional management for a low fee. Our senior portfolio manager, Mike Clare, is the lead PM on SPLT. And he's out there just monitoring all the holdings, making sure that we've got adequate equity coverage, taking advantage of situations in the market where one of the prefs goes on sale for the the reasons that I mentioned to you because of company specific events. And so we're hoping to see a little bit of value add over the long run just from that.
Yeah,
So again, yeah. So again, it's just several good reasons to hold SPLT. Lots of good reasons to hold split prefs directly too. So I encourage each individual investor to do what makes them the most comfortable.
yeah, and the management fee is right there. It's 0.5, so it's very, very low for an actively managed fund where you guys are always monitoring, looking at the resets. And we've discussed this in a previous video, so I'll put our past videos as well where we discuss this previous SPLT videos in the video description below in case my audience is interested. And the last question has to do with taxes that I want to ask you about. So if you look at the distribution, so typically, Chris, split share preferreds are mostly or a lot of eligible dividends, especially the quadravest ones. I think they're all eligible dividends. If I look at the breakdown of SPLT, very, very tax efficient. I see a little over half of the distributions here. You see the breakdown. So let's say 5.2 cents. A little over half is going to be eligible dividend, but then the rest is rock. So there is quite a high portion of rock. It's not quite half-half, but it's almost half-half. Why is there rock in there? A lot of investors are fearful of rock. I've explained this a million times. Can you just explain, the tax breakdown of SPLT? Why is it about half-half?
I love tax questions, Adrian. No problem. I can explain this. This what you're seeing here, about 45% return of capital for the 2023 tax year. This is a result of the differences in tax rules between trusts and corporations. So, as you know, split share corps issue split share prefs, and SPLT is a mutual fund trust. So that's just a different legal structure than a corporation. And how mutual fund trusts are taxed in an individual's hand, it's what's known as an accrual basis. So basically, if you own SPLT and SPLT declares a dividend and it's due and payable but not yet paid, you're taxed on that amount, right? So everybody that owns SPLT, we're taxed for the final distribution of the year and all the other distributions on the date that they were recorded, on the record date. For corps, which are what the split prefs are units of, those are taxable on a cash basis. So usually, SPLT and all the splits prefs that it holds all declare dividends and they pay them about 10 business days later, so the middle of the following month after they became due. So you don't pay taxes on corps, or you're not taxed on corp dividends until you actually receive the dividend. So what happened at the end of 2023 is that it was the end of a calendar quarter. A number of the prefs that SPLT held declared dividends on that date, which weren't taxable until January. And also there's a number of monthly pays too in the portfolio. So it was a big slug of dividends that were declared on the 31st, 29th, like around the year end there. So SPLT unit holders are taxed on those dividends, but SPLT itself hadn't actually received the dividends and from the corps, which are taxable when they're received, until January. So it's a timing mismatch. It's a first-year startup issue. I can assure you that every cent that was paid out by SPLT was funded by dividends.
That's what I was going to ask you. Yeah,
exactly. When SPLT paid its December dividend in January, mid-January, it had received those corp dividends from the split pref portfolio, and it had all the money to fund them. So you won't see that again. We're being very careful to match the distributions paid by the dividends received for SPLT, and just given that the first year is rolled over, this is a timing issue that's kind of boxed into 2023. You won't see that in 2024.
Okay, makes sense. So in short, it's not like you're giving people, SPLT is not paying out more than it earns. It's not just your own money given, you're not just giving the capital back, right? You're paying out what SPLT is earning. A lot of investors are worried because they just go read the definition, but I've covered this a million times with different fund managers, so we all say the same thing. So thanks for that explanation. It makes sense. If there's nothing else on SPLT, Chris, I'd love to move on to BMAX if you don't mind.
Oh, for sure. Let's do it.
So BMAX is the Brompton Enhanced Multi-Asset income ETF. So this is what I would call a leveraged all-in-one, which is my personal, favorite style of income-oriented products out there. And you guys have it a little bit different because it's not 100% equity. It's about 70% equity and 30% fixed under the fixed income umbrella, including 10% in SPLT, which is
Mhm.
the ETF that we talked about right here. Here it is. And then there's 20% in your preferred grade ETF, which is mostly US preferred shares. And then the 70% is basically your 7 covered call ETFs, which is very diversified, your Tech One, financials, Europe, et cetera, et cetera. You have the breakdown here. So tell me a little bit about BMAX, because BMAX also, fantastic news, has raised the distribution from 10 cents to 10.4 cents, a little over 4% dividend distribution increase. So tell me a little bit about that, how you were able to raise the dividend. Maybe we could start on that.
Sure. Yeah. I mean, this is just a reflection of the BMAX has done quite well. It's increased its trading price since we listed it originally. We were paying $1.20 a year originally, and when we came around to reviewing our distributions in January, we saw that we had some flexibility to pay out a little bit more, so we went to $1.25 a year. So again, a small bump, but just indicative of BMAX and how it's been able to hold in and grow its NAV. I mean, I'll share with you a couple of
Yeah.
comparisons, because I know BMAX is often compared to HDIF and HDIV, so some competitors from Harvest and Hamilton. They do have the equity cover call exposure. What they don't have, as you mentioned, is the alternative fixed income exposure
Right.
through US Prefs, through SPLT holdings, which brings some stability and just adds to the ability for BMAX to pay distributions. They also don't have TLF, which is our tech cover call fund, the Brompton Tech Leaders Income. And what that is the number one performing actively managed ETF over the last 10 years that's listed on the TSX. It didn't
Wow.
have, they may have different healthcare exposures and what have you, but our HIG, Brompton Global Healthcare, has powered ahead this year, and it's done very well. We have VREA, our Real Assets Fund, which has gone in the direction you want it to go, kind of upward and from the bottom left to the top right. So it's been doing very well too. So just overall, we've been very pleased with the performance of this fund, and we're glad that the NAV has grown. And we wanted to keep the distribution rate at around the 10% level when we went to review our distributions. So just as another comment, just versus the competitive funds that we mentioned, HDIF and HDIV. This is a little chart that one of my analysts put together, and this talks about downside volatility. So when markets draw down, how well does your fund do? Brompton is in the blue line versus Hamilton and Harvest here. So you can see more stability in volatile markets from Brompton. It just doesn't drop as much when markets take a bit of a nosedive. So
That
we
makes
think that that's
sense.
a benefit. Yeah, it's a lot of it is the fixed income exposure that
Of
provides some
course, of
stability.
course. So this is that graph is really important. I think investors who own BMAX, especially more conservative investors who want stability, this is going to be music to their ears, and it's basically what I've been saying. So this is why I love when you come on, Chris, because you kind of justify what I've been saying about your funds. Of course, you're going to have more stability, aka less volatility when there is volatility, because you have a portion in that fixed income. So that, I mean, the graphs don't lie. You see that compared to funds that are also leveraged, but 100% equity versus your 70/30. So
Mm-hmm.
great chart, great chart.
Here's another way to cut that same message. Really, it's
Mm,
along the bottom we have standard deviation, which is the typical way to measure risk for investment funds, and
mhm.
along the top, along the left side here, that axis is returns. And Brompton again is the blue dot. Where you want to be is you want to be as high as you can and as far to the left as you can in this graph, because that means that you've got the highest return for the lowest risk. Brompton is holding its own versus the Hamilton and Harvest product, but with significantly less risk as measured by standard deviation. This is just since common inception, when we listed BMAX in 2022, the performance of all three of these funds since that date through to the end of March.
Awesome.
So yeah,
That
that's
looks like a good.
another backing. Excuse me. Go ahead, Adrian.
I was gonna say that looks like a nice, 20 to 25% less volatile than the other two. That's what it kind of looked like to me, approximately. I was just,
Yeah,
I think it looked like 17, 18 to 12 and a half, 13. So that's quite
about
a bit less volatile.
4 or 5 points less volatile out of
Hmm.
just on the standard deviation front. And this is taking BMAX and putting a few more comps against it. The top, we have BMAX in blue, and the other lines are different types of balanced funds that are kind of the category returns that Morningstar puts out. So BMAX has been doing very well versus them. And the bottom chart is against actual balanced funds, some of the bigger ones offered by Mackenzie, Fidelity, CIBC, that kind of thing, big fund complexes. So you can see that investors have done very well by putting their balanced fund allocations to BMAX.
Yeah, that leverage must help a lot too, right? It must do good when the markets are on an upward trend and over time. And just to clarify, in case my audience is, when you say balanced funds, typically these are funds that are like all in one that have both equity and fixed income, and typically I believe it's a 60-40 approximately.
About right. Yeah.
Okay.
Yeah, they vary
Okay.
they vary somewhat, but that's the standard 60-40. So we're a little bit
Yeah.
more equity focused, and we have the different kinds of fixed income than you would typically see in a balanced fund. Typically it's like an aggregate bond exposure, corporate debt and a little bit of high yield and some governments and that sort of thing. So we're completely in preferred shares. So they're not identical, but you're seeing that play out in terms of improved returns versus the categories.
Well, if you ask my opinion, I much rather get the preferred shares of a split than actual preferred shares or other types of bonds and whatever. So wow, that's great. I literally have no questions because those graphs basically said it all, justify what we've discussed in the past and what I've said before about these two ETFs. And maybe one final question, and I don't want to draw on tax stuff again. BMAX mostly rock.
Mhm.
It's not you're not paying out more than BMAX is earning. Obviously, that wouldn't be the case if you raise the distribution. So if you could just confirm that one more time for the audience, that would be great.
Sure. Well, I'll tell you, we take a total return approach to setting our distribution levels in many of our equity cover call funds. The reason just being, I mean, there's a number of philosophical reasons for it, but the reason being that we don't require our PMs to write any specific level of coverage on our cover call mandates. What we do is we give them cover calls as a tool to enhance total returns, and we encourage them in times when it doesn't make sense to not write at all. And we encourage them, for when the markets are very volatile and premiums are high, that you can receive for writing cover calls, to go ahead and write to whatever level you think is prudent. But this is kind of not an income generating strategy for us. This is a total return enhancing strategy for us. And there are periods when it doesn't make sense to write cover calls. There's periods like in 2022 when markets were very volatile, and then into the early part of 2023 when you should be writing cover calls because you want to protect your downside and you want to take advantage of high volatilities. There's periods like the latest 9 months, which have been just kind of straight up for equity markets, and it doesn't make sense to write cover calls. So in those periods when there's not a lot of writing, or even in times when there's a lot of volatility and you end up finishing far in the money for some of your cover calls that you write, and then some months you're way out of the money and you just roll your positions. There's opportunities to generate return of capital, and so that's what we've been doing. We've been setting distribution levels based on our view of long-term return potential for our ETFs, and not saying, okay, you guys, you have to write 50% coverage at the money every month so that you can generate some kind of return. So it does sometimes result in ROC or capital gains being paid out of the fund, and this is just part of our managed distribution strategy. I mean, I think you would find a similar kind of tax result in most cover call funds, whether or not they're right at the money or not. It's just that in certain of our funds, the performance has been superior. So that's the main difference.
Yeah, you went well above and beyond answering that question, and you even talked about the cover call strategy, which my channel is all about, which is great. And we've discussed it before. You basically repeating the same thing, which is great. It just shows the consistency. This is this goes for not only BMAX but all the the cover call ETFs inside of it. If you could just confirm, this is an active approach to covered call writing. It's not a set in stone approach, and you guys are focused. You have a total return first perspective, not a income first perspective. So. Some people wonder why the Brompton products have less yield. Well, because you guys are focusing more on total return and using covered calls tactically, I would say, in times where it makes sense, and the results speak for themselves. Obviously, you guys are right up there in terms of performance with the other guys who have 100% equity. So I find that very impressive, and obviously what you're doing works. And I've said this before, I said it again. If investors really want that stability, more consistency, and are like income, but they really want to put a focus on total return. I think something like a BMAX would be great in their portfolio. So I have no further questions. Chris, you stayed with us a while as usual. Thanks so much for your time. If there's anything else you'd like to say, go ahead. But my perspective, I'm good.
Okay, that's great. I just want to thank you for having me on again, Adrian, and I just want to thank all your viewers
Anytime.
for joining today. And feel free to reach out to us at Brompton if you want to go on our website and call our investor line. Go right ahead, and Daniel will pick up the phone, and he's very good at answering most questions that come up.
Well,
So
I hope
encourage,
Daniel's not going to
encourage
get
anybody
mad
that
if
would
he
like to
gets
reach out.
flooded with calls because you said that, but you said it. So guys, take it from Chris. You guys could call. And what I'll do as well for my audience is put the links to other past SPLT and BMAX videos because we've discussed them before as well. We talk about them as well. So yeah, that's perfect. So thanks again, Chris.
Thanks, Adrian.
Take care.